Hi everybody, I'm Dr. Sudipto Ghosh. Welcome you to Knowledge School. This is the fourth module of Mutual Fund for Beginners. In this video, we are going to learn about how to select a good mutual fund scheme, when to exit from a mutual fund investment fallacies, precaution in mutual fund investment. In this video, we are going to learn how to select a good mutual fund scheme. Identify your goals and risk tolerance level. Ascertain your risk appetite. Are you willing to take more risks for higher returns? Equity schemes are best suited when your goal is long-term and risk appetite is moderate to high. Otherwise, invest in balanced funds or debt-oriented schemes. Selecting a fund house. Identify a fund house which has given a returns consistently higher than the markets in rising markets, but in a falling market, the negative returns given by it are lesser in comparison to the negative returns given by a market index such as Nifty. How to select a scheme? Choosing a scheme which has given consistently good returns for the past several years. Evaluate the returns since inception or at least for the past 3 years. Do not invest in schemes with positive but declining returns in the past 3 years. Avoid investing in schemes with a small corpus, say below 50 crores rupees, of schemes which have an extremely large corpus. You can take some help from the websites given below. Some of the good websites are Mutual Funds India, Money Control, Value Research Online. Before investing in mutual funds, you can do some research work. Visit the website of the selected fund house to check the scheme's performance. Check the track record of the fund manager in managing the scheme or the others. Choose the schemes which have a fund manager with a good track record. What are the other aspects you can examine? Study the diversification of the scheme's portfolio, options available, liquidity or redemption procedure, etc. While making a final selection, select a scheme which scores high on all the above parameters and is also in conformity with our objectives. Now, when to exit from a mutual fund? A decision to exit from a mutual fund scheme must be taken when the fund had been underperforming consistently for 3 years or more. The investment strategy of the scheme is changed to one which is not in conformity with its original goals. The scheme in which you invested is merged with another one that was consistently underperforming or giving negative returns. A well-performing fund manager exits the scheme or is replaced by a less experienced fund manager. The scheme size grows too big. The large size may affect its ability to deploy assets faster and remuneratively. This may lower the fund's performance. The scheme has met your objectives fully and your target net asset value is within reach. You need the money to fulfill the objective with which the corpus was accumulated. Let us learn about the mutual fund investment fallacies. Mutual fund investments are not risky. They are equally exposed to the risks associated with the underlying securities. Fund schemes with star rankings are better buys. Star rankings are given on the basis of past performance, which is no guarantee of future returns. Funds invest only in stocks that constitute its benchmark index. That is not entirely true, as the benchmarks are chosen for evaluating the fund's performance. A mutual fund advisor is necessary for investing in. Every fund house offers a web-based facility for investing in online. Besides, investor service centers exist in major towns to assist investors to directly invest with the fund house. What are the precautions to be taken in mutual fund investment? Resist investing all the funds in one or more schemes. Diversify between fund house and within fund houses across schemes. Avoid investing in new fund offers. Rather, invest in schemes with proven track record of consistent performance. Do not be lured by mutual funds backed by big promoters. Although a mutual fund may be promoted by a big name in the financial sector, the promoters do not guarantee its performance. Promoting institutions cannot be held responsible for losses to the unit holders due to poor performance of a mutual fund. Hence, the investor must not act under any such presumption while investing. Investing in ultra-small funds may be blunder. Such funds are more aggressive in investing in order to report good returns, but may be highly risky. Do not go by tips and rumors or advice given by non-professionals. There is no alternative to thorough research before investing. In our next video, that is the 5th module, Mutual Fund for Beginners, we will learn about open-ended schemes, closed-ended schemes, equity-based funds, debt-based schemes, hybrid funds, and other types of funds. I expect you will subscribe the channel and share the video as much as you can.